Okay, starting out the second hour of the weekend edition of the Korelin Economics Report. I'm Al Korelin. My friend Brent Cook from Exploration Insights has joined me. We're going to chat a little bit about something that Brent has made a very good living at for a long, long time. I haven't done too bad in it also for a long, long time, and that's the resource industry. We're going to talk specifically about our views on where the security segment of the resource market is headed. You know, a week ago we had a big shift on Friday. Gold was up about, on June 1st, gold was up over $60 an ounce. Silver was up significantly. A lot of the mining companies that I'm invested in, and you know what every single one of those is, also started to move up a little bit in price. But here's the million-dollar question. Is that going to continue, Brett, do you think, for the next 6 to 12 months?
No, is the short answer. I think we'll see a lot of volatility, but certainly in the sector that I deal with, which is junior exploration mining sector, I think we've got 6 months to a year of real devastation. And that sounds negative, actually that's a very positive statement.
It's a good time to buy.
It's going to be a good time to buy because what's happened is that over the past 2 years, a lot of money's come in and been indiscriminately funding things, and I think what we're going to see them do, and what we are seeing them do, is indiscriminately sell things. So yes, for those of us who watch closely, this is a good time coming.
I think it's a great time to buy right now, but I don't think it's necessarily doom and gloom at all for the resource stocks. Now let me tell you why I say that, because I'd be curious as to what your opinion is. In our portfolio, we're about probably 60% up in the companies that we have purchased, and probably about 40% down. The companies that we're down in right now, I think, represent buying opportunities. But the companies that we invested in, and a lot of them, Brent, were companies that that you and I have discussed in the past, we've actually done relatively well. In some cases, we've done very, very well. I think that because of economic conditions around the world, and I know this could be turned around against me for lack of better terms, but I think because of economic conditions around the world, Europe, the United States, the impact of Europe on China, etc., I think people are going to become more and more concerned with the conventional markets, and I personally think that the metals sector and the securities relating to the companies in that sector, I think could do relatively well. Now, does relatively well mean a raging bull market? No, I don't think so. But I think we're going to see price appreciation.
I don't see it.
Okay, I mean, that's what it's, yeah, I mean, everybody has an opinion, and I certainly appreciate yours and everybody's.
So, I mean, basically what we're talking about is the global markets not doing well, in fact, doing pretty bad.
Economies, not markets, economies,
well,
yeah.
I think the stock market as well.
Okay.
But that is not going to engender people to want to start investing in the riskiest sector in the whole industry, which is the one we're in. So I don't think that's going to happen. I've
got to take Bob Moriarty's side on that one, and Bob and I discussed that probably, 2 or 3 years ago, and Bob's comment was, I think we're going to see people invest in things, i.e. the securities. And I said, Bob, you're crazy. Why would people invest in securities? They don't represent things. And he said, no, you're crazy. He said the shares of these companies represent hard assets. Why wouldn't people invest in those?
Okay, I would agree that the ones that actually have a hard asset, but 90% of the companies that's in the room don't have anything but a dream, a geologist's idea of what's at depth.
I would have to say, yeah, I agree, but I would have to say that those aren't the kind of companies that I invest in.
Okay, well, that's fair.
And you know what? I've known you for a long time, and those aren't really the kind of companies that you invest in either. No. You invest in companies that are fundamentally sound. They've got the management, they've got the assets, 9 times out of 10 they have the capital, or if not, at least the ability to raise the capital. I'll bet you're doing pretty good.
Yeah, and I'm looking forward to this sector in general getting worse, because those few companies that you and I own are going to get hammered just as well as the rest of them. Or not as well, but they're going to come down as well, I think, which is great if I'm looking to deploy more money.
I think what we're both in effect saying that now is a good time for new investment. That's what I'm trying to say.
Yeah, I would say I'm not jumping in all at once. I'm looking over the coming year that I think there's going to be a lot of opportunities.
I have told listeners on this show for the 20 years that I've been doing it, You don't jump into anything all at once. I mean, our listeners are aware that my wife and I are 25% in real estate, 25% in the conventional market, and 25% in the resource sector, and that's a combination of the securities, and the commodities themselves. I think if you're diversified, you're going to be fine.
Okay. I would say yes, sort of.
Yes, sort of.
I think it makes sense to be diversified.
Of course.
But I also think it makes sense to know exactly what you own, and that's kind of what we're saying, is that know what you own, study these companies, know the people, know the asset, know what it's really worth, not what somebody says it's worth.
Absolutely no question about that. A colleague of ours and a close friend of yours and a friend of mine, Rick Rule, gave a very, very interesting speech in New York, what was it, a month or so ago, and in that speech he said, you want to look really carefully at the companies, and the reason you want to do that is, he said, you know what, look at their balance sheets, look at their income statements, look at the amount of money they're spending, for example, on salaries. He said it's obscene how much money companies that have absolutely no business paying these huge salaries to their officers and directors, you've got no business being there. You don't want to invest in companies like that. I'm going to go out on a limb and I'm going to say, I'll bet you never have. A long time ago.
I wish you were right.
A long time ago.
I've made plenty of mistakes.
We've all made mistakes, but at least we know how to I'd like to think we know how to separate the wheat from the chaff right now.
I think so.
I think that,
in fact, I've hired another geologist to work with me on my letter. I don't know if you noticed that, but now there's two of us doing this, because I think it's really, really a good time to be looking, and it's even more important not to make a mistake.
I think it's a great time to be looking. Now let's talk a little bit about sectors. I happen to be very bullish on precious metals, and so far it's worked for me. I also happen to be very bullish on energy, specifically oil. What are your thoughts?
Precious metals, I don't try to make big predictions.
I'm not asking for a big prediction.
My assumption is, what I base most of my evaluations on, is the gold price is going to be $1,500 at the end of the year.
What's wrong with that?
Nothing.
Absolutely nothing.
So and as long as a company makes money, or the project has the potential to make good money at $1,500, it's worth owning.
Here's a little insurance, in my opinion, for people like you and I who write checks to buy stock in these companies. A lot of the companies, Brett, that we're invested in, gold could drop to $700 an ounce, $600 an ounce, and they'd be just fine. Not all, but a lot.
Okay.
I mean, I remember when gold was flirting with $500 an ounce after it had come back after it had doubled from roughly $2.25, $2.30 an ounce. I remember there was a lot of euphoria in our community because people were saying, this is great, $500 an ounce gold, we're going to do just fine.
Yeah, but we didn't.
We
did well, but this is a controversial kind of thing we're going on here. But the cash cost of production
has gone up. No, I grant you. The cash cost of production has gone up.
So margins are expanded.
They're not what they were 10 years ago. And I really want to stress that. Brett brings up a very, very interesting point. Profitability, let me rephrase this. Income statements at $600 gold 10 years ago were a horse of a different color from income statements today. I mean, you're absolutely right. Costs have escalated significantly, but for $1,500 an ounce gold, we got a great stable industry, I think.
Yes.
I mean, how low? I'd take it down to maybe $1,250. Would you?
Yeah. Well, there's studies I've seen where the all-in total cost, including exploration, G&A, et cetera, is about $1,300 an ounce on industry average.
Okay.
So what that tells us is that the companies with deposits that are below that, let's say their cost of cash production is $500 and below, extremely valuable. Those are the ones that the majors are going to buy.
Exactly. I agree 1,000% on that. Ladies and gentlemen, if you want to get some great information on this sector, Exploration Insights, Brent Cook's publication is very, very good. We provide a link to that on our website. We highly endorse it. I'm not saying that because that we get a commission for whatever he sells. We absolutely do not. Brent's a good guy. He's a very knowledgeable guy, and I have nothing but respect for his publication. Brent, thanks so much, buddy.
Thank you. Glad to see you.